one more thing about refinance, of course, there's so often people ask about PMI, private mortgage insurance, and refinancing so they can get rid of private mortgage insurance. Will you talk a little bit about that and what is private mortgage insurance, what it takes to get rid of it, and what are some of the restrictions of not being able to get rid of PMI?
Oh yeah, there's a lot of different ways to describe PMI. Private mortgage insurance is placed on a mortgage. A conventional loan is placed on a conventional loan when your down payment is less than 20%. However, we have some really great mortgage insurance companies today. In today's world, I've seen the evolution process over these last 29 years, that you can make a down payment at 5%, not the required 20%, because you don't have to make a 20% down payment anymore to have a mortgage, as long as your credit is in good standing and you have the ability to repay. That's the focus phrase, ability to repay. But at 5% down, we can structure a loan with no mortgage insurance. So 10% down, we can structure a loan with no mortgage insurance. No longer do you have to make 20% down or 20% down payment to have no mortgage insurance. Mortgage insurance is simply default insurance. Should you default on this loan, there's a third party that will ensure the mortgage lender that they don't lose their shirt on that loan. So the mortgage insurance companies that we deal with today do a fantastic job analyzing risk, no matter what the down payment is. So if someone came to me today, hey, I did take out a mortgage, it has mortgage insurance. Again, you've got to be talking to a mortgage specialist who is experienced and understands how to look at your situation. How long have you had the property? What's the current market value of the property? What's the current balance on your property? And determine that equity spread to see what your loan to value is, which we as an acronym call an LTV. So once we determine some of these things, we then can make a decision or help you make a decision as the borrower on whether mortgage insurance can be dropped at this specific time, or do you want to make a cash investment into your mortgage to eliminate PMI, private mortgage insurance. So again, a discussion with someone who's experienced is so critical and so necessary.
And it's so interesting because, again, these are financial decisions that will impact you for years to come.
Yes.
And that's part of the reason that, I want to have these conversations, because so often I'm just absolutely amazed by, and I want to say it, by people that I really look up to. And then I realize, oh my gosh, they really don't understand refinance, and they really don't understand how to make that decision so that it's a good decision that helps them for years to come. And, again, I'm in this field. I've been in here for, many years now. And so for me, it's second nature. And I think it's that way for whatever you do. If you're a dentist or a doctor or, a construction worker, you think about the ins and outs as no big deal. And that's one of the reasons that I want to always continue having conversations about some of the basics. And I want to call them the basics of real estate investing. And one of the biggest barriers I have found, and in my life, as well as clients, friends, family, whatnot, is the idea that I already know all about it. You don't have to tell me anything. And I've caught myself where I'm like, oh, no, I know all about that. And then I'm like, wait a minute, I didn't know that. And so it's part of the reason that I know sometimes it seems so basic when I ask you some of those questions about refinancing a mortgage, but it's really important to understand how to compare and contrast and see if a refinance is right for you at this time. So again, it's not as simple as just saying, oh, well, I can get one interest rate, 1 point lower. It depends on the full picture, and looking at the PMI, private mortgage insurance, the mortgage insurance, MI, or even if it's time to change from one mortgage, as you call it, product, to another one, because the other one that I hear a lot in a refinance is, I have an FHA loan and now I'm ready to refinance out into a conventional. So will you talk just a little bit about I want to say the pros and the cons of going from one mortgage type, like an FHA, into a conventional? What's good, what's bad?
Sure. On an FHA loan, the Federal Housing Administration, it's a government insured loan that no matter what your down payment is, you always have mortgage insurance. So if your down payment, the normal FHA government insured loan down payment is 3.5%. So you're going to have mortgage insurance for the entirety of that loan. If your down payment is 10% or more on an FHA loan, government insured loan, then you're going to have mortgage insurance for the first 11 years. So what if you get to for example, in this scenario, if you get to year 5 and your appreciation or depreciation in equity in your property has increased so to the point where you now realize or come to understand, I have 20% equity in my property, I no longer need mortgage insurance.
Yay!
That's great news.
Yes.
So you then want to talk to a mortgage specialist, a loan officer, who can then run the numbers for you to show you if you go from an FHA loan to a conventional loan with no mortgage insurance requirement at all, what that option looks like, what that monthly payment looks like, what those closing costs look like, so you can make a wise, educated financial decision. How long will it take me to recoup my money? How much will it save me each month versus how much it costs me? And what is actually the rate difference and the annual percentage rate, all the costs involved in this equation. These are the things that a true loan officer, an experienced loan officer, a mortgage specialist can help answer for you to give you peace of mind that you're making a good financial decision.